The liquidity ratios are used to determine a company's ability to pay off its short-term debts obligations. Generally, the higher the value of the ratio, the larger the margin of safety that the company possesses to cover short-term debts. Common liquidity ratios include the current ratio, the quick ratio, and the operating cash flow ratio. In general, the coverage of liquid assets to short-term liabilities, the better it is, as it is a clear signal that a company can pay its debts that are coming due in the near future and still fund its ongoing operations. On the other hand, a company with a low coverage rate should raise a red flag for investors, as it may be a sign that the company will have difficulty meeting its running operations as well as meeting its obligation.